right, welcome to the conversation on the TYT network. You know that a lot of the money that went in the stimulus packages went to the top corporations in the world. But what kind of companies did it go to? Well, we're going to bring in Jesse Eisinger. He is a senior reporter and editor at ProPublica, and he has written about this. One of his articles is called "The Bailout is Working for the Rich." He's also got a book, and I can't tell you the full name of it, but the Chicken Poop Club, why the Justice Department fails to prosecute executives. So that's fun. Jesse, first of all, thanks for coming on the show. We appreciate it. The articles you wrote are really edifying. You talk about how a lot of the money went to private equity companies. For folks who are unfamiliar, what is a private equity company, and why did the money go there, and why is it wrong for it to go there?
Sure, and well done on the book title. I've heard many iterations of it on the public airwaves. So thank you. A private equity firm, they used to be known as corporate raiders or LBO firms. They largely came to sort of the public consciousness in the 80s when they were funded by the likes of Michael Milken. And today, they're established corporations with respectable names like Blackstone and Carlyle and KKR, and they take over companies and own companies. What they primarily do is take companies private from the public markets, or take family-run businesses and buy them, and they buy them with a thin slice of equity. So they're putting a little bit of their own money in, and then they borrow the rest of it. So it's highly leveraged, it's highly indebted. And these companies are therefore quite vulnerable to any kind of downturn, like, say, a global pandemic hits. But what happens when they win big for the equity holders. So the returns are extremely good. And that's why these companies have really thrived. And what I mean by the companies is the private equity companies, because the companies that are owned by private equity companies don't thrive at all. They certainly don't thrive by helping their workers, but they often just go bankrupt and belly up. Hertz is a fine example of that, which we saw go bankrupt last week, file for bankruptcy last week. That is the kind of industry that has been dominated by private equity ownership for decades now.
Yeah, and we've talked a little bit about it on the show before, and not every company there is a bad actor, but there are some institutional problems when you, especially on the companies that load up a company or corporation that they buy with debt and take some of that debt and put it in their pocket. Well, now you've set up a situation where the company has a much more difficult chance of recovery. And a lot of people don't know. That's why a lot of the major retailers went out of business, not because of the online competition, but because they were bought by private equity and loaded up with debt. Given that that is a business model, it's understandable why we'd be worried about corporate debt. And we were worried about corporate debt, and on the Young Turks, we were talking about the problems of corporate debt. Nomi Prince was on warning about the problems of corporate debt even before coronavirus happened and the initial stock market crash happened. So now what the crash happens, when they do the bailouts, Jesse, where does it go? How does it get to the Apollos and the Blackstones of the world?
Yeah, you're exactly right. And you can put aside the arguments about whether it's good or bad, the industry of private equity, for a moment now, and we can get back to that for a second, because what we're talking about here is the federal government's response to the bailout, response to the coronavirus crisis, which is a bailout. And we have bailed out the capital markets, we've bailed out investors and capital, and we've also bailed out workers. And I don't want to minimize the amount of money that's gone to workers for expanded unemployment and the stimulus checks, because it's unprecedented. It's huge amounts, much more than we did in the stimulus in the wake of the 2008 financial crisis. But the Federal Reserve, the Fed, the central bank, is putting much, much more money into the capital markets than anything compared to workers. And what they're also doing, which is really incredible, is they've said, our help is unlimited. So what we're doing with workers is we have given them limited time and limited money. The expanded unemployment expires in July. And for capital, we have given unlimited money with no conditions, zero conditions, much, much more money than workers. So that's the fundamental problem here. And then as an ancillary problem, some of that Fed money is going to private equity through its bailout of the riskiest debt markets, the junk bond market. And that's really what I think is problematic from the Fed response.
So there's layers of this. So Jesse, when they bail out a normal corporation, let's say Hertz, well, the money's going to flow to the owner of Hertz, which is the private equity company, right?
Yeah.
And so if the markets were working normally, they would not get a bailout under capitalism. Under capitalism, they would not get a bailout, and Hertz would go under. And if enough of the Hertzes went under, the private equity company that owns it would then go under. Why? Because they bought a company that couldn't survive under these situations. And by the way, a lot of good companies can't survive under these situations, but the ones going under first are usually the ones that had trouble to begin with. And so that's another issue. But there's another layer to the problem that you're pointing out, which is that they're now buying junk bonds or really risky assets. So Jesse, break that down. In 2008, when they didn't they also buy toxic assets? Is there an extra layer here in how toxic these particular assets are?
It's a good question. What the Fed did for the first time in the wake of 2008 is buy assets, but they bought assets they were somewhat familiar with. They bought mortgages, kind of debt assets that were very similar in kind to the kinds of things that they had been doing before. Historically, it was treasuries. Then they expanded to mortgage assets, and that was the center of our financial crisis, was our housing market, as you remember. Here, what they're doing is they've expanded this to something absolutely new, which is corporate debt. In fact, they haven't done a lot of it. They've just said they're going to do it, but by merely having said they're going to do it, they have buoyed the markets, both debt markets and the stock market, as we can all see. So it's been an extraordinarily successful program for the Fed so far. So what they've done is they haven't just said they were going to buy the safest corporate debt, AAA debt. What they've said is we're going to go down, down, down to the riskier debt and the riskier debt to junk bonds, and we're going to buy junk bonds. And this is kind of astonishing. We're going to buy the crappiest, most indebted companies, and we're going to buy unlimited amounts of that. And you can trust us that we are going to step in and save these markets if they get shaky. That merely by saying that, they have boosted the stocks of private equity firms. They've boosted the bond market. They have allowed companies to issue massive amounts of debt. It's been a boon for investors all over the world. And the reason why this is really risky is we are putting much more debt onto already risky companies, just like what Nomi was saying to you a few months ago. Those companies were risky then, they're riskier now. We've got a worse economy, and the Fed has basically said, we're going to insure these companies, we're going to guarantee that. And so the money flows, as you say, from the bond market into the pockets of the private equity firms in a variety of ways. And that's not helping workers. It's not helping keep people in their jobs, and it's not helping allow people to bridge the gap from this unemployment period to when the economy recovers. It's just helping line the pockets of many private equity firm owners who are billionaires.
So, Jesse, they're also killing capitalism. And ironically, the Republicans killed capitalism because, look, let's think about it this way. If you have a safe company that you're investing in, and let's say you make a 2% return, which would be very low, right? But, and you've taken a certain amount of risk, very little risk to get that return. Or you could put it into a really risky company and make a 20% return. Well, if the federal government and the Federal Reserve says, don't worry, no one's ever going to go out of business, we're the insurance of last resort, then you'd be an idiot to not put it into junk bonds because you're going to make 20%. So why the hell would you put it into a safe company? You'd put it in the worst company you could imagine to make as high a return as you can, because if it goes south, the Federal Reserve's going to buy it anyway. Am I missing anything about that, or did they just completely and utterly kill capitalism?
We really have transformed the economy now, and we have socialism for the wealthy in this country. And we learned that in 2008 when the federal government bailed out the banks and didn't punish any bankers. That's what my book is about, is the lack of accountability, elite impunity, the fact that we can't punish or prosecute CEOs in this country anymore. We did have a series of financial reforms that were going to protect the capital markets from just this kind of risk. And then they blow up again, and they're so fragile that the Fed has to step in and bail out these markets again. We have an extraordinarily broken financial system, capital market system, and economy, and this is just displaying that. It's on display here.
Yeah. Jesse Eisinger, thank you so much. Appreciate it. One more question. Jesse, what on God's green earth does it mean for the Fed to buy something? Can they sell it later? And what if they can't sell it later? Does it just disappear into a black hole?
It's a good question. People were really worried about them buying all these assets and not being able to sell them. And then over the last decade, they were really able to reduce their balance sheet. Now the balance sheet has exploded again. They bought all these assets again, and we're going to see. It's likely that the taxpayer is going to take some loss here. So what that means is when the Fed goes to sell, they're going to sell for less money than they paid for it. And the idea, if that were a good thing to do, if they were stepping in to really save the markets, and that was trickling down to the rest of us, then I would say that's fine for the Fed to take a loss in order to save the capital markets and save the economy. The problem is who's benefiting and who's not benefiting. We do want to save workers in a terrible pandemic that's thrown 30, 40 million people out of work through no fault of their own. What we don't need to do is be saving billionaires and ignoring those workers. And so taking a loss there is okay.
I don't know that I agree with that, funny enough. What does it mean for the Fed to take $1 trillion loss, as an example? $1 billion, $1 million, $1 trillion, what difference does it make? It does make a difference. But if they took it, let's say that the losses added up to $1 trillion, I literally don't know what happens next.
I mean, no one really knows what happens next. It's a completely valid question. The Fed can print money, so they can keep on printing, and we pay our debts back in dollars because we print dollars and we pay it back in our own currency. So there might be a little bit of inflation. People have worried about the dollar value collapsing and inflation, but for the last decade, hasn't materialized at all. So I'm much less worried about the Fed taking those kind of risks and excess debt in the American government. I'm much more worried that we are going to emerge from this having reinforced all of the inequality that we built up before the 2008 crisis and that has only expanded in the decades since, which is manifesting itself in our politics and everywhere in every corner of society and certainly in the markets. And that's the thing that I'm really worried about. If the Fed were stepping in to ameliorate that by helping workers, it would be okay for the Fed to eventually take losses, I think. But you're right that it's and people are worried about it. Just the fact that what's true is that the central bank worries is kind of excess debt buying that they've done for the last decade didn't materialize into any problems.
All right, Jesse Eisinger, senior reporter and editor at ProPublica. Thank you for joining us. We appreciate it.
Thanks so much for having me.
Thanks for watching this free clip of the Young Turks. Don't forget to become a TYT member today. For more exclusive content, join now at tyt.com/join.